Hey, it's Paulo Brands, owner of Clear to Close Brokers. In this video right here, we're going to talk about points as it relates to mortgages. So what is the point? Well, let's go ahead. What do you say we dive right into that? All right, let's first define what a point is. So a mortgage point, also known as a discount point, are options for buyers to pay upfront fees at closing to get a lower interest rate. Now, the term points is also a common way of referring to a percentage of your loan amount. For example, if you were to pay 1 point for an interest rate, that 1 point would cost 1% of your loan amount. So if your loan amount was 400,000, it would cost you 4,000 additional funds. If it was 900,000, then it would be 900,000. Now, before we get into comparing points versus no points, I want to give you a great illustration of what an actual rate sheet looks like. So when you get to choose your interest rate, it's just not two choices. A rate with no points and a rate with 1 point. You actually get to choose really any interest rate you kind of want. You have to think of it almost as a flagpole with the lowest rates on top, the highest rates on the bottom, and you can adjust up and down that flagpole as you see fit. So take a look at this example right here. If you looked at 6.875, which is about right there, and you go all the way, well, let's just keep it simple. The green means you get money back towards your closing costs. The red means it's going to cost you an additional fee, which makes sense. Getting an interest rate of 5.75 is going to cost you money, whereas 7.5 is actually going to give you back money. So what I want to do, now that you know this, and by the way, this is what separates lenders right here, because their fee structure is built into this. Some lenders can give you better interest rates with a certain amount of cost than others. Keep that in mind. So with this said, we're going to compare a 6.875 with a 6.5% that has a cost of 1.24. So to do that, I'm going to remove this and I'm going to bring up my trusty little loan illustration. By the way, if you're working with a lender and you don't have your own portal just like this, you should definitely reach out to me. This is an absolute game changer. It creates complete transparency. Now, before I dive into this, let me give you the ground rules or the playground rules with this loan illustration. There's no fees included, such as appraisal fees, lender fees, title fees. We're not including taxes or insurance. We stripped out everything except for principal and interest rate, and the cost of the discount point, so you can see how they react towards one another. So what you're going to notice, there's a purchase price of $800,000, same loan amount. Now the column on your left is with no points. That's at 6.875. The column on your right is with a 6.5%. Now I want you to notice that the payment goes from $4,204 to $4,045, which is going to save you $159 per month. But I also want you to notice the cash to close goes from $160 to $167. So now that you know that, it makes sense to pay that point. Your cash to close is going to go up, your payment's going to go down, etc. How do you know if it's really worth it or not? So before we get to that, I want to share with you or show you one thing, is that when you take a look here at this chart right here, this chart tells us it's about 40 months before you break even. So if we did 39, this would have a savings over here. 40 months, this has a little savings. So 39, 40 months is the break-even point, which means that additional cost you paid up front divided by the monthly savings, that's where the break-even point is. Does that make sense? Good. All right, let's bring it back to our slideshow here. Now that you know this and you know what a point is and all that great stuff, these are things to consider when deciding whether or not getting a point or paying for a point is right for you and your family. Number one, here's something that you need to know, that it is tax deductible. However, you want to consult your CPA to make sure that you're going to get the full benefit of that point. If you are, it's going to make it a little bit different, paint a little bit different picture than if you weren't. Number two, especially if you're closing on a home, do you have the available funds? Last thing you want to do is pay for a point, which would leave you with no reserves once you owned your first house, especially your first house, because you always want to close with a reserve, because now that you own your own home, if something were to happen, now you need to pay for it, not your landlord. So number two is make sure you have additional funds at closing. Number three, how long will you be in the property for? So we've already established this illustration that we just looked at. It's a 40-month recoup fee. So if you were to move before then, you would not get the full benefit of paying that point by paying a lower payment per, or the cost up front by paying a lower payment each month. And number four, it's the same concept as number three. Do you anticipate being able to refinance? You see, especially in this market today, a lot of people are wanting to pay points to get that lower interest rate, but the likelihood of them refinancing in 1 to 2 years is pretty great given the information that we know right now. So when you decide whether or not to pay a point, you always want to take those four things into consideration before you make your decision. So today we went over a lot. We went over what a point is, how to calculate a point, the differences between a point and no points. We went over a rate sheet, which gives you an idea of all the different options you have as a consumer. We went over the things to consider before you decide whether or not to pay for a point or not. If you have any questions or anything I can help you out with, I would absolutely love the opportunity to speak with you. But with that, Paul O'Brien, Clear to Close Brokers. Have a great day. Bye.